Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending August 10th, 2018. What you see on the screen here is a weekly chart, or I'm sorry, a daily chart of the E-mini S&P 500 futures. Before I jump in, just a real quick summary this week. We were going fairly okay until we got towards the end of the week when we saw Turkey kind of derail the index rise that we were having. And a lot of this was caused by some of the issues with Turkey's debt and then their tremendous devaluation of the Lira. It's just all these machinations going over in Turkey kind of remind me. I don't know what it is about summer months, but if you look at the summer months going back in time, I mean, for those of you that were trading back then in the late 90s, 97, I believe, we had the devaluation of the Thai Baht, which caused the Asian debt crisis. Back then, all Asian markets were pretty much similarly configured. And when the Thai Baht fell, then all these other Asian emerging market countries started going down also. And that just kind of brought everything down back then. And then in July of 97, summer of 97, we had the devaluation. I'm sorry, the August of 98, rather. We saw the Russian ruble completely devalue, and that caused major issues on a global scale as well. And then just a few years ago, about 3 years ago, in August of 2015, we saw China devalued the Yuan over 2.5%, causing the volatility here to go up over 50 in the VIX in a very short period of time. And now in August of this year, we're seeing the machinations in the Turkish markets with their Lira. I mean, this week it's fallen over 23%. Now, I don't think this has as much of a cause for contagion as we saw before. But it always seems to be in the summer months and always seems to be the July, August timeframe when this stuff happens, which I find really interesting. But the Lira fall, where we've seen some of the biggest issues, is mostly in some of the larger European banks in Spain and Italy and France. Those are the areas that are concentrated because they've got a lot of loans to Turkish banks and companies over in Turkey to the tune of north of 100 billion. So if Turkey has major problems, then guess what? The repayment of that money is also going to be a major issue as well, back to those banks in Spain, Italy, and France. So that caused a little bit of an agina issue with Europe, which then kind of spilled over into the US markets as we saw this Friday. And we also saw it spill over into emerging markets as well. So that caused some agina. Now, I don't think it's going to have the potential to expand and cause broader underlying contagion like we saw with the Thai Baht devaluation in the summer of 97, or the Russian Ruble devaluation in the summer of 98, or the Chinese devaluation of the Yuan in August of 2015. But it does always seem to happen in August, July, August timeframe in the summer months. And it always starts in some unlikely corner of the planet where everything else is going good. And the next thing you know, 2 weeks later, they all trace it back to some small, tiny country that just caused problems. But that's where we are right now. We've got, ironically, the markets, the S&P is near all-time highs, as you can see on the chart here. I mean, we backed off a bit. If we look at this chart here, you can see that the S&P, or the E-mini futures, closed at 28.39. Now the all-time highs is 28.78. We got closer to that. We were only about 15 points south of there, just at the beginning of the week. And yet, if we look at the forward PE ratio, back in January when we were at 28.78, the forward PE ratio was around 18.6. Now the forward PE ratio of the S&P is around 16.7 or so. So we're almost up there, but the PE ratio is a lot lower, okay? And, you know, to the tune of about 12% lower. And why is that? And that's primarily because we've had stronger earnings growth. Earnings have been growing faster than the increase in the index price. So that has reduced the PE ratio. Hence, I don't think we're in a situation similar to this past January of just seeing double-digit drops over the next 5 or 6 2 or 3 or 4 weeks where we just have a total letdown of the markets. I do not see that happening at this time. In fact, we've had about 458 companies report so far through earnings. We're almost done. And we're seeing a double-digit growth rate so far of about 24.6%. So that would put the S&P, assuming we don't have a total capitulation of the remaining companies, which I don't see. That puts the S&P on track for its third consecutive quarter of double-digit gains. So these strong earnings are providing enough of a support floor foundation for index price that we're not seeing more of a contagion from whether the trade tariffs or this issue over in Turkey. So these are some of the things that I see as a good thing. Okay, so looking at this, you can see here we were starting to see a little bit of a divergence as we were porpoising higher. So a little bit of a pullback even to the 2800 area. 2818, 2800 area. You can see down in this area here would make sense to me. We've got a wider S1 support range here that runs right around 2810 down to about 2885 area, which also we find our S&P 500 50 EMA sitting kind of in the lower quadrant of this support zone. So I don't see us going much lower. Should it really start to unwind, I see a lot of buying stepping in north of the 28 open price because we've had a huge right around the 27.25 area. That's around fair value for prices going back this entire year. That's kind of where most of the volume has occurred in the S&P 500, right around 27.25. So that would be my longer term support. I don't see us going back down much lower than that. In fact, I see us pulling back a little bit, but not too much. All right, strong earnings has a way of keeping price action high. Of course, there's always risk to the markets. There's always a risk to some unknown popping up. Like we had with the continued degradation of the Turkish Lira and then the potential contagion over to Europe. But I think, again, as I said, it's contained to just those 3 countries over in Europe. I don't see it really getting much beyond those 3, right? So that is kind of where I'm looking at the markets right now. I don't see too much more outside of that. So if we come over and we look at Nasdaq, I mean, Nasdaq's been on a tear, right? And if we look at for the week, by the way, the Nasdaq was really the only market, the major index. I mean, it finished up for the week, just barely. The other Dow and the S&P were down for the week. The volatility actually came up. We got down very low in vol, right around the 10 area, which for the given the geopolitical constraints globally right now, and some of the other risk factors that I pointed out on some of my weekend updates here, I just didn't see the VIX at 10. That's why I was having our members go long volatility the end of this past last week. We were going long vol, and we made some trades in Tesla when Musk had his moment in the sun with Tesla. We still got some trades on in Tesla, some interesting options trades that are just playing this thing. And I think there's some interesting diagonal plays in this also, which I'm going to spell out with our members this Sunday evening. But you can see where we're looking at NASDAQ. I think the support area underneath NASDAQ is the 50 EMA, sitting just north of the 72.14 area. You can see the rolling porpoise of the move higher with the divergence down in the MACD. So again, that to me shows that we're going to have a little bit more weakness. I mean, I was expecting, quite frankly, to make new all-time highs in NASDAQ. And then once it did that, it would just roll over, make the highs just to make the highs, because price action sometimes likes to set records and then move back. But we didn't get it. I think the market started peeling off early to start the day, and it just went from there. And then, of course, if we look at the Dow was the underperformer all year, still is. You can see the Dow is having trouble getting over this R1 zone up in this area here to challenge this prior pivot high. The Dow is well off the 2018 highs, which we had back in January, along with all the other indexes. It's the one that is the weakest, primarily because of the trade tariff issue and the fights going on with China. Now, I'm getting word that NAFTA may be At least the Mexican component of NAFTA may be solved before midterm elections. Canada may go a little bit further. I think we'll probably get the issue with Europe solved. And then that leaves China. And it's kind of a pissing contest, really, between us and China. And generally, the Trump administration is not known for backing down. They'll change the rules of the road. The markets right now are pricing in the fact that behind the scenes, because they are talking behind the scenes, regardless of what you read on the headline news, or the rat brain business journal of the day, which would be the National Enquirer, or the closely second widely followed rat brain trader paper of record, the USA Today, the color by numbers USA Today. So those rags, when they post these things out here, retail traders just commonly react to the headline news. And by that point in time, by the time you read the news, the move had already been made. And about 60 to 70% of it already been factored into the market. So the market right now is not really factoring in a 200 billion trade tariff tax issue. Now, should that occur, we're going to see some more sell-off in the markets. Right now, the markets are assuming that that's going to be solved before midterm. I tend to believe them because I just don't see Trump going into midterm with the markets cratering. It gives too much ammunition to the Democratic Party. So Trump, if anything, he's an opportunist, and we'll see what that does. And whether your belief is Republican or Democrat, for us, we don't really care. From a trading market perspective, we just trade the price action and what it's willing to give us. And this is what I'm looking at right now. So you can see the Dow is starting to taper off just a little bit, again, with a little bit of a bearish slant to it. So we'll see how this market reacts Sunday going into Monday with the Turkish issues. But again, very strong underlying growth factors across all indexes. The only downside, obviously, is we are seeing some signs of inflation come back in. I think wage pressure will pick up a little bit, and then hence higher interest rates. And once we finally break above that 3% level, and then that holds and we kind of grind higher, then we'll see how equities want to play. In January, they didn't want to play very well, but we went up through the 3% area very quickly. If we just kind of slowly grind up higher, that's a little bit better. But once we get over 320, 3.25, 3.4 area, I think that's going to start to take a toll on U.S. equities, and it's going to pull back a little bit more. The U.S. dollar, meanwhile, has been very strong. On Friday, all money went into the dollar. All currencies crashed against the dollar because of the when you have times of global strife, the dollar gets stronger. So does the yen. The yen tends to get a lot stronger as well. Okay. So this is kind of where we're looking right now. And then finally, if we look at the Russell was the weakest affected, meaning it was the strongest performer this past week, especially on Friday. You can see the Russell is just holding this longer term going all the way back to February, this trend line here. And we're making closes above this trend line. So until we take out this trend line, I'm still going to be neutral to slightly bullish in the Russell. Okay. If we look at the Vanguard All World Index, you can see here, we're way down here. I mean, we're near the 2018 lows. So globally, the markets are not nearly as strong as the U.S. markets. You can see the area down here where we are in relation to the 2018. That's not the high, folks. That's the open for 2018. And then you can see down here where we're near the 2018 low. MACD's moving below zero, so it does show downward pressure. And then, of course, if we look at the Chinese market, it is ugly, ugly, ugly. And let me just move. And in fact, it was moving. I didn't even get a chance to change it for this weekly update here. But let me just move it down here like that. So we are at this level right here. Right, so we've got from a high peak to a low peak, and let me just edit this thing here, and I'm going to give you. We're now down, I suspect, over. Let's see if we hit over 30% to the downside, because we're at 29%. So let me just see what that does for us. Yep, 30.73%. So from a high to a low, right? From the January peak to where we hit this low back on August the 6th, the markets in China are down 70.73%. We're probably back down underneath 30%, but we're right in this area here. And you can see these value areas, which are all established very low. Okay. So China's market is horrible right now. They're getting killed by these tariff issues. Why? Because we're in a much better financial condition than China. China makes most of their GDP on exports. The U.S. does not. US GDP, 70% is consumer spending. That's why China is so desperately trying to change their whole macro theme from export-driven economy to consumer-driven economy. They want their consumers to spend, and it's going to take a couple of decades to get there. So that's a long-term issue for China. Otherwise, right now, they're still export-driven. So Trump can punish them a lot more than they can punish us, all right? We will take a ding in our equity market, but nowhere near what China is. They're 30, they're really getting hit hard. So these are the things that are going globally. And if we look at emerging markets, you can see here in the emerging market, again, just like the Vanguard All World Index, it was not quite a bearish market for emerging markets when it hit its lows back around June, end of June, going into July. It's when it hit, emerging markets hit its lows. We've been making this move higher, but we had a pretty good fall. You can see this gap down lower on Friday down here, and that was because of the Turkish Lira. I do not believe, as I said earlier, that that has the contagion effect of, say, the Asian debt crisis started with the Thai Baht back in 97. I don't see that, because back in 97, all Asian countries were set up almost the exact same way. They were doing the same debt ratios. They had the same banking structure. And when one failed, and they all just like dominoes started falling, and then the contagion took effect. Here with Turkey, you're only looking at, Spain, Italy, and France as the countries that could cause the issue. Okay. And I don't see that. But there is the irrational view of the markets. We could have our, to quote what Barron said, our Minsky moment. And Minsky was an economics professor in the U.S., died in the 90s, but he was famous for saying that long-term, prolonged term growth begats short-term volatility and bear markets, meaning the markets were not always irrational, and human nature is not always rational, which means the longer term markets go to the upside, lenders start lending more money, and they keep lending until irrationality plays a tune into they lend too much, they overextend, and then the markets react the other way. They start going down, and then that causes the Feds to counter react, and that causes these bear markets. So bull markets and long-term bull markets cause bear markets, and vice versa. That was the Minsky postulation, which is counter what some of the other economists say, that markets are always fairly priced, and human nature is always rational. And we always know that that's not the case, at least on a short-term basis. Longer-term markets are rational, but short-term, there's a lot of irrationality built in, which causes these extreme bouts of bullishness and bearishness behavior. And that's kind of how our trading methodology works here at our user group. So we take advantage of this. But now you can see emerging markets really down on Friday. So we're going to watch this. And just a hint, guys, pay close attention to the US dollar. If we come in, and let me just open up currencies here, and let's look at the dollar. If we take a look at the US dollar here, it was up dramatically, almost a full percentage point. Look at this. And I haven't even moved it on this platform I'm doing this presentation on. It made new 2018 highs here. Look at that. I mean, you talk about a breakout. And that is all because of this move higher right in this area here. And that was all because of the Lira, and money just poured into the US. I mean, just big time, big time. So we moved right up to what I've got as a classic resistance pivot point of 96.49. We're right up in that area right there. So if I back it out, right, and then just kind of give you a little bit more of a macro view of the dollar and where it can go. I'll put it on a weekly chart here. And if we look at it from a weekly perspective, you can see right here where I've got the 2018 high, 2018 open, 2018 low. Okay. And you can see here on that 2018 low, let me just take some of these off the screen here so it kind of takes some of the clutter off. You can see here how we've just been moving. When we broke out down at the bottom down here in February, March, it's just, all bets are off. And you can see we got a tight coupling up here from about the 97 down to about the high 90, the 96 area, 96, 97. So this will be our next resistance point with the US dollar. And this goes all the way back to the summer months of 2017. So we're getting ourselves back up here. And keep in mind the Feds, there's over a 95% chance of a Fed rate hike this September, and then over a 60% chance of a Fed rate hike in December. That's already priced into the market. So that only means more money is the dollar has a chance to move up higher unless we see some more hawkish behavior from Super Mario Draghi across Europe. If they stay where they are, they keep their stance, the spread between U.S. 10-year and German Bunds, British gilt, and other 10-year debt across Europe is going to widen, which means more money is going to come into the U.S. from these countries in some of our debt, which will keep our interest rates lower than they should be. Right now, our 10-year should probably be over 4%. And it's not. At some point, it's going to play catch up, just like the US dollar, and it's going to drive up very hard. And then the equities are going to roll over in that Minsky moment. They're going to get afraid. Extreme is going to be a little bit of a fear trade. And we're going to see the equities roll, interest rates move up higher. So we're going to be ready for it. It's going to be a trade that we're going to want to take. If you're not a member, I highly encourage you to come in because some of these trades can put some pretty serious coin in your pocket in a quick move here. The other one that's really interesting to me is the British pound. Now, in the British pound, you can see here, and I've talked about this. I don't talk about it every week in my weekly update, but I do talk about it. For our members, I talk about it much more, but you can see how we were playing the bullish side. Every time it would get towards the top end of this channel, we would be tighten our stops and get out, and then we'd go to the middle of the channel or lower and we'd get a buy signal, we'd take the buy signal. And it worked out really well until it didn't. And it didn't right up in this area here where, again, we were stopped out. And then when it came down, we were looking for a buy signal as it was coming right through the middle. We didn't get it. And then as it came down to the bottom end of our channel, we were looking for a buy signal. We still didn't get it. What could have happened is we could have gotten a buy signal. We would have gone long and then we would have gotten stopped out if it was a false signal, but it didn't. It just kept going on down. And now look at it now. I had said that once we got out of this channel and we broke through this prior pivot low of 13281, we're going a lot lower. And sure enough, we're back down around 1.27. You can see there is a value area established at 1.24. Should this not hold up, if it comes down to this area here, I will be looking for longs. In fact, I think the British pound is going to be, again, another really good buy opportunity, like we saw with the Brexit vote back over here. In March of 2019, the Great Britain's going to break away from the European Union. And if they don't have their Brexit issues solved, which most politicians, they're timeline politicians. They wait until the last moment to get anything done, which is why I hate politicians. Planning, once you become a politician, you throw planning out the door and you only react when you have to, almost like a 5-year-old kid, right? Or when you're just getting into school and you wait until the very last second to where you have to do your homework. You never plan ahead. And your parents are all over you and all that kind of stuff. Well, it's the same thing with politicians. They're like petulant children. And that's kind of what we're seeing here with Great Britain and what they're doing here. There will be a time when there will be some great long opportunities in the British pound. Just not yet. The euro came right down to my spot, okay? Look at what I had called, and I've talked about this before. I had called 114 in the euro, and where are we sitting now? 114.4. We came right down to my spot. This is a weekly chart. If we look at it on a daily basis, you'll see it came down almost on a timing standpoint because my timing indicators, which are based off of GAN, called for it in the middle of August, sometime from the middle of August to the middle of September. And we actually hit it almost right in the middle of August. So we should expect some consolidation in this area for a bit, and then where we go from here is going to all be determined by the this initial huge move lower, just bam, bam. And then and as I adjust this, I got to move this down here to the new lows because because wherever the dollar goes, the euro is just the mirror image opposite of that. So we made new lows at 114.1. I had said 114.5, and we finished at 114.4. So our target was hit. So for those following along with us, our members, I would, as I've said before, start tightening up some stops here. This turned out to be a nice little move lower here for the euro. Even though this grind higher was moving up over here in July, it was a time to be looking for shorts in the euro, not longs. And the euro got all the way back up to almost 118, a little over 118.5. And I was still saying 114 is where we're going to end up. And sure enough, that's where we are. All right, so that's a little bit about the currencies. And then, of course, if we just look at the yen is another currency like the dollar that moves higher in times of safety. And you can see here where the yen moved up on Friday. It's having a hard time, as you can see over here on the left side of the screen, the 50 EMA. We move up above it, and the very next day it closes right back below it again. We have not closed above the 50 EMA in the yen, so I'm going to watch this very closely. You can see the 50 crossing the 200 EMA on a longer term basis. I've always said those crosses serve as almost like bug zapper places where price action wants to come back into. So if I were to extend a line of a 50 to 200 EMA over like that, that could be a natural target. We're right at a value area though. You can see right at this area here, just we're slightly above a value area for the yen coming back the past 90 days. So if I were to move it back out, just show kind of a year-to-date view of the yen, you can see there's two value areas here. One sitting right where we are now, and then another bigger value area up a little bit higher, which would take us through the 200 EMA to the upside. All right. So that's kind of what I'm looking at on currencies, guys. Now, if we look at the treasuries and we look at the bond market, do you remember what I've said? Every time the bond market gets up in this area here, I'm more interested in shorting it than going long. We're not quite up there. We're kind of in this no man's view right up here. We had a strong day on Friday with bonds, primarily because it was a flight to safety. And money moved into the US dollar and they moved in the bonds, which is to be expected. So interest rates came down. If we look at the 10-year rate, look at this, guys. The 10-year rate came all the way back down and finished Friday around 2.85. And it actually moved up in May to 3.11, right? So we're down dramatically on the 10-year rate. And really, realistically, given the strength of our economy, our double-digit growth through 3 consecutive quarters with S&P earnings, I'm surprised we're not up over 3.5 or 4. Normally, we'd be up over 3.5 or 4%, but because we got such a bifurcation in interest rates between here and Europe, money's coming from Europe into here. When that reverses, folks, there's going to be a trade of the lifetime in bonds, in currencies, and equities. It's going to be really a pretty good move to the tune of making your annual nut in 2 months, 3 months time. That's what I'm sensing. And members will kind of go through that. It'll be a good trade for you. Now, if we come over and we look at metals, right? Look at gold, guys. Gold is, given the fear in the markets on Friday, what did gold do? It actually went lower. This is another reason why gold is going to be in this longer term. I think we're in this longer term consolidation period. Hell, gold may even move up a little bit and come back down a little bit. We're in a longer term consolidation period for gold. And we've been that way since we broke out of this near the 2018 open price back in June. Okay. And then it's just been Katie bar the door. We're down near a value area down in this area right here. And we're going to consolidate here before we decide to move higher or lower. I think the risk right now near term is more lower than higher. I've on record as saying over the next 2 years, gold's going to be back up over 1,300 and probably challenge 1,400. You can see all these resistance points up here. There's 2016, 2017, and 2018 high prices for the year. So there's a tremendous amount of resistance up here. But I do believe over the next 2 years, the equities are going to roll and gold is going to be higher. Right now is not the time to be long gold, but there will be a time for it. We'll be watching it. Same thing with silver. If we look at the silver market, look at this. We broke both of these. We broke both of these symmetrical triangles to the downside, which was the forecasted break for the technical market. And now we're finding some consolidation down here in silver as well. Like gold, I think silver is going to have a great opportunity to move higher, just not yet. Picking up some silver or shares in SLV may make some sense because over the next 2 years, you'll do well. Over the next 90 days, it's just going to be choppy, possibly even some downside moves. So that's why I would say just start picking up a small percentage at time and then give yourself some time for it to work out. Okay. If we look at copper, which is an industrial metal, copper has reacted. China is one of the biggest buyers of copper. Look, this is copper futures. Look at that. That was a huge, huge move. We're going to consolidate down here in copper. As soon as China rights itself, we're going to see copper start to move higher and kind of a sympathy bounce up a little bit. I think longer term it could roll back over again, but short term, I think it's neutral to slightly higher as China starts to improve. Okay. But I showed you the tracking index for China, and it's still ugly right now. Oil. Well, let's look at oil for a second. Oil is going to be interesting. There's so many things push-pulling oil. It's not even funny. You got a lot of geopolitical risk. You've got OPEC and Russia trying to increase production a little bit, take advantage of a little bit higher oil prices. You've got the sanctions on Iran that kicked off Monday at midnight this past week, but not the oil sanctions. They're going to kick in another, I think, in November. That's going to have a tendency to move oil higher. Yet Trump has come out and said he's thinking about releasing oil from the U.S. Strategic Oil Reserve. So you got that issue out there. There is a ton of headline risk, or shall I say Trump Twitter risk in the oil markets. But net, no matter how you slice it, I think oil is probably going to go higher. There's only so much that Trump can do with WTI, but I think Brent is going to go higher, which is going to raise the spread between Brent and WTI. If we look at Brent, here's Brent. You can see here how Brent has followed this huge upsloping trend line, and we just broke it by the middle of July. And now we've tried to make it up and we broke it again. We tried to hit it and we're breaking to the downside. This would suggest every break, it's suggesting more downside in this thing in Brent, right? Same thing with WTI. I was calling for near term oil moving lower, both Brent and WTI. If we look at the spread between the two of them, I think this spread has a higher propensity to move higher. Right now, the value area for this is right around 5 to 5.25 point spread. That is about the 5-year average. I do believe this is going to have a higher propensity to move higher, meaning the spread between Brent and WTI is going to widen. We took this trade up here with a very high spread between the two. And it was a fairly good high probability trade. There's no such thing as a sure thing, but it was a high prob trade where we were taking it. It's $1,000 a point, but it's hedged because we were short Brent futures and we were long oil futures. So some of these spread paired trades work out fairly well in the commodity market. The other thing that really got pounded this week was soybeans. I mean, soybeans took a hit. If we look at soybean futures, look at that. I mean, in this move here, this is a daily chart. On this move here, came all the way back down into this area here. Now, we have been, and I was a macro theme down in this area here of going long soybeans. And one way to trade that, if you can't trade futures, is just SOYB, which is an ETF for soybeans. We're still profitable in it. We held on to it with this thing here. I think longer term, this is going to go a lot higher. Near term, it can go lower depending on where these tariffs go. But keep in mind, this is not like an asset like a Tesla or some stock, right? This is a food commodity product. Food And because of the growing middle class in China and everywhere else, people want to eat better and they spend more money on food and higher quality food. And that's global phenomena, not just China or in the US. So there's an old theory that says very low commodity prices, the cure for very low commodity prices is very low commodity prices because they reverse and eventually they move back up again. Those of you that remember the elasticity of demand from economics in your old high school days, I thought probably thought you'd never have to brush that off again, but that's so true. So anytime we get a big severe dislocation in the commodity markets, I love it, especially in food products like soybeans. And if we look at wheat, it is moving. It also moved hard down, right? We had the USDA crop report. So it was basically more bearish for price action than anything else. You could see wheat moving down, but it has still moved up. It doesn't look like the soybean chart. And then if we look at corn, it also moved down as well, right? Corn is more similar to soybeans as far as the way the price action's been moving. So this is something that we're going to watch very closely. But I think longer term, these things have the risk is to a upside move. Near term, we could come back down again, but I'd use it as a buying opportunity rather than a selling opportunity. All right, everybody. That's one other thing I wanted to show here. You can see on my ratio charts here, one of the ones that I've been looking at and playing with is growth over value. And you can see here that we're porpoising down. This downward slope, does suggest that value is slowly starting to come back into the market over growth, right? And you can see if I were to, well, it's not a very good line there, but you can see here as I draw this line here, when it's going down like that, that means value stocks, right? Value stocks are exceeding growth stocks, right? And we think of growth basically as tech and others that don't pay as much in dividends. And value for the past decades, since we've been moving up, has been underperforming growth. But as markets start to reach economic peak cycles before the business cycle starts to roll over, we see things like this. All right. So again, canary in the coal mine, maybe, maybe not. But we're seeing money slowly come back into value over growth because this is a ratio chart of discretionary over staples. And when it moves down, that means staples is outperforming discretionary. All right. Granted, over the past week, we've had a little bit of a move higher, but will that hold up? This Friday, discretionary underperformed value. So we'll see how this thing plays itself out. But again, these are just some of the things that we're looking at here. Now, for our members, we've got our Sunday night weekly market watch. If you're a non-member, I'm putting some really strong discount opportunities out there for you. We're growing our global base. So I'd love to see you come in. As you can tell by my weekly updates, we do everything from commodities to futures to U.S. equities. We play other countries, currencies, all sorts of things. And if you can't get in them, we find ETFs that you can play with stock. We also do pair trade. So it's a great way to come in and just play the global markets. A lot of our members are, we got European, South African, Eastern Europe, we got Asian, we even have some in China, as well as Japan, Australia, New Zealand members. So come on in and join us, North American, Latin American members. I like that. We've got a nice little global mix of folks here, that's the way the markets are running anyway. We've had, since I founded our group in 2008, more of a macro global theme. Because just looking at where technology was going in the trading world, you have to trade globally. Think locally, but trade globally, right? Or think globally and trade locally. I think I had it backwards. But that's kind of where we're going, guys. All right, have a great weekend, members. I'll see you this Sunday evening for our weekly market watch. Take care, folks. Ciao.